Great. Well, I think we've started here. Thank you, everyone, for joining. Good morning, and I guess depending on where you're dialing in from. I just wanted to give a quick introduction here, and then I'll turn it over to Avi and the panelists. So, hello, everyone, and welcome to the TresVista Talk Webinar. It's a forum where we engage with senior asset managers and advisors across a broad range of topics. So quick intro on TresVista. We're the leading outsourcing firm for the financial services industry, supporting over 1,000 clients with over 10 trillion in AUM. We support our clients by providing skilled outsourced support across due diligence, business development, portfolio management, data analytics, and other activities. And of course, to learn more, feel free to visit our website. We also have a podcast where we speak and have one-on-one conversations with folks. And without further ado, I'd like to thank our panelists for joining us today and introduce our moderator for the panel, Abilash Jaikumar. Take it away, Avi.
Thank you, Amir, and thank you everyone for joining us today. I'm Abilash Jaikumar, co-founder and managing director of TresVista, and today I have the privilege of discussing the secondaries market with some of the leaders in the industry. Among our distinguished panelists today, we have Steve Lessar. Steve is the West Point man, if you can notice by the banner behind him. Steve is the managing director and co-head of secondaries and liquidity solutions in the private equity partners business at BlackRock Alternative Investors. It's one of the newer strategies at the world's largest asset manager. Before joining BlackRock in 2018, Steve was a managing director and global co-head of the private equity secondary business in the alternative investment and manager selection group at Goldman Sachs, where he was responsible for all aspects of the business, including capital raising, investment strategy, transaction execution, and business development. Thank you, Steve, for joining us today. Next, we have Christophe Browne. Christophe is a managing director at ICG Strategic Equity and sits on the Secondaries Investment Committee. ICG is a global alternative asset manager in private debt, credit, and equity with nearly 50 billion of assets in third-party funds and proprietary capital under management. ICG Strategic Equity is a market-leading specialist in private equity investments through GP-led fund restructuring transactions, recapitalizations, and hold fund liquidity solutions. In January of this year, they closed their Strategic Equity Fund 3 at 2.4 billion, more than doubling the size of its $1.1 billion predecessor fund. Christophe was previously a founding partner of New Globe Capital Partners, a firm focused on PE fund restructuring transactions as well. Thank you, Christophe, for being here. Next, we have Yann Robard. Yann is the managing partner of Whitehorse Liquidity Partners, a private equity firm focused on providing structured liquidity solutions to the private equity markets. The firm has closed or committed to 55 transactions with a value of over $4.5 billion since 2015. Whitehorse closed their third fund at $2 billion in 2019. Yann founded Whitehorse in 2015 and has over 19 years of private equity and investment banking experience. Before Whitehorse, Yann spent 13 years at CPPIB, most recently as managing director, head of secondaries and co-investments. He was responsible for investing in private equity, secondaries, and co-investments on a global basis. And last but not least, we have Nigel E. Nigel is a senior managing director and head of Evercore's Private Capital Advisor Group, the global leader by deal value of advisors focused on secondary transactions for private fund interests. Prior to Evercore, Nigel was managing director and global co-head of the private funds group at UBS. Nigel is a recognized leader in the business, bringing more than 20 years of experience advising investors and fund sponsors and has advised on tens of billions of secondary transactions. Gentlemen, thank you so much for joining me today. Maybe to drive right into it, Nigel, I can start with you. Maybe for some historical context, you can discuss how this downturn is different than the last one, and what are the differences in approaches to valuation you're seeing, and what are some of the systemic changes you saw come out of the last one that you might anticipate happening in this go around? Nigel, I think you might be on mute. Not yet. Well, I think Nigel's got some network issues.
Abby, why don't I just take that one?
All right. Please, Christophe.
I'll start off.
Yeah, I'm back.
All right, great.
I think we heard you.
I think I'm back. So apologies for that. I think last time around it was a much smaller market. There was less capital, and we had a much more distressed LP base than we have right now, and we had no GP-driven secondary market that was worth talking about. So when we look at the sort of the secondary market context, you take those factors into account, plus the fact that financial services companies actually accounted for about 40% of the selling volume last time. It was actually, in some ways much worse than the situation that we have right now. If we look at the situation in 2020 post-COVID, it is quite different in the sense that markets have snapped back very quickly. Financing markets were back within 6 weeks. And the denominator problem that LPs suffered from last time really is not an issue this time. In fact, I was speaking to the CIO of a public fund only a few minutes ago, and they said they've actually been much more offensive this time, where they were actually distressed last time. So, I think, where we are all-time high in terms of capital in the secondary market, the GP-driven market is back. And so I think there's much less distress, and it feels like, everyone is open for business. So a significantly more sophisticated market, significant amount of capital on the buy side, but also having an LP side is much less distressed and more opportunistic, and a GP business that is definitely aware of the tools within the secondary market and willing to avail themselves of it. So where we are right now, it feels like the market is coming back much faster, that GPs are engaging in terms of finding liquidity solutions for their LPs that, on the basis of needing more duration and needing more capital. And an LP business currently that is actually pretty quiet, and we don't really expect in any volume to be coming back until maybe the fourth quarter of the year. So very, very different from last time, and I think there's a notion that this market will be somewhat similar to the great financial crisis, the aftermath of that. But in some ways, it is quite different. And maybe with that, I'll pass over to the other panelists.
Yeah, look, I mean, the thing is that, the interesting thing is that if we would have done this webinar like 2-3 weeks ago, then, or the story would have been very different. I've never seen a market that is shifting so quickly with so many nuances and so many different tools that people can use to tactically reallocate their portfolios. And institutional investors are reacting themselves to a situation where things are changing very drastically, very quickly. And if you would have asked in March or April, a lot of people would have said, this is going to be a boom for the secondary market. There's going to be a lot of distress. There's going to be a lot of LP secondaries. There's going to be a denominator effect. And, we have to wait until Q1 marks are out because we know we need to price off of, new valuations rather than peak valuations. But at the end of the day, the market's going to recover and there's going to be a big boom in the second half. All of that has shifted in the recent 2 to 3 weeks, because with the markets that have come back, the denominator effect has gone away. LPs feel less stressed. Buyers are now, looking at opportunities that they said, well, we were pressing pause because we thought the opportunities were coming. Now all of a sudden, everybody's like, ooh, well, maybe there's not going to be as many opportunities as there was before. And so now buyers are having to be pretty creative in terms of how do we deploy capital in a world where potentially there's going to be less supply than we had anticipated. And buyers have to, at the end of the way, they deploy capital. That's why they've raised capital. And so what you're seeing is that people are shifting very drastically around, how can we get creative in order to be able to deploy capital in a world where there's a lot of nuances in the market. So I would have said the March story was the LP story. The April story was the pref story. Everybody was talking about, let's do under the fund pref because we're going to need to shore up capital for offensive and defensive reasons for portfolio companies. Then all of a sudden things shifted in the public markets, and that story has gone from pref to maybe more tools like NAV-based lending. And so there is so much going on in such a short period of time that buyers have got to get to react to these market opportunities and find what are they going to lean into, where's the pockets of opportunities, and then really kind of lean into it. So I think that from our perspective, I think it's a fascinating time right now. I think that the market is going through so many changes so quickly, and the reality is that buyers are finding themselves needing to shift quickly to the market opportunities.
I completely agree, Yann, and I think as you continue that narrative, I think the back half of 2020 should be the story of GP-led transactions at least coming back. And I think just to reiterate something that that Nigel said. In the 2008-2009 financial crisis, the GP-led market literally did not exist. So what I find so exciting and fascinating about this time around is we had a GP-led market that had grown explosively since 2012, and it was just reaching a point of maturity and mainstream institutionalization at a time when it's hit with this unprecedented crisis. So now you have an established market where we can tap into the creativity and the alignment of GPs. Some of the most sophisticated private equity investors on the planet now have an entire toolkit to come up with GP-led solutions for their LPs to provide optionality and just to manage through this crisis with an entirely new set of options that we're most excited about. But I think, as Yann said, that you're really not going to see that come to fruition until the back half of this year. Yann mentioned the Q1 March marks. We think it's really going to be after the June 30th marks, which will come out at the end of the summer, where we can start to see a surge in activity.
But that itself is interesting, because if you think about Q2 marks, we all thought, well, earnings softness, obviously, Q1 was the valuation impact, Q2 and Q3 is going to be the earnings impact. The problem is that the markets have popped back up. And now you end up in a situation where markets are up, 25% since March 31st, and that could potentially offset, 1 quarter of softness in the LTM earnings. And when you talk to GPs right now, they're confused about their valuation policies, because they're like, well, the market tells me I should be marking up my portfolio, but that seems to defy gravity. So, at the end of the day, what are we going to do? And every GP's got their own personality. Some are more conservative, some are more aggressive. Some have took big Q1 hits, some have not. And so there's a lot of questions around what's going to happen to Q2. It could be that Q1 marks are the marks to buy off of at the end of the day. That's the unknown at this point. Sorry, Steve.
Yeah, it could, but I don't disagree with anything you guys have said. I would think about it a little differently, in that this economic shock is a really big one, and it's going to ripple through the markets over a lot longer than just 90 days. And so one compare contrast is, depending on what you think of as the real beginning of the global financial crisis, was it the Bear Stearns event, or was it the Lehman Brothers event, which, by the way, there was 90 days between those two events, right? And then after Lehman, the market was really slow for 6 months, and then the second half of 09, 10, 11 were really good buying opportunities for the secondary market. So I wouldn't want the viewers on this panel to think that all of us think tactically deploying a bunch of money in 90 days immediately post-COVID. If you don't do that, you've missed the opportunity. I think we think the ripple effects are going to be much, much greater, and it's kind of like a seismic shift. Totally agree. It's not a denominator effect problem at all, not at all. It could be a public markets decline again, but right now it's not. But I think what we're saying is, for certain types of investors, think about endowments, university endowments, school endowments, they are very concerned about liquidity, and they're looking at their portfolio, saying, their entire portfolio, not just private equity, but their entire endowment, and saying, we are going to be more stressed on our endowment because tuition's lower, the bookstore's closed, there's no sporting events. Many sources of revenue are just not going to be there. And then we look at our private equity portfolio specifically and see distributions might be really slow for a while, so accelerating that liquidity. So long-winded way of saying, I don't disagree with anything that's been said, but I think the BlackRock view is that this is setting up to be pretty interesting kind of multi-year opportunity that does have some similarities to the GFC.
Yeah, so if we don't think, I think everyone feels uniformly that the denominator effect is not what's going to drive transaction volume, but is it going to be liquidity concerns, or is it going to be valuations? What do you think is going to be the driver of volume in 2020?
Innovation. There's just new tools in the tool set, and people have different ways to tactically reallocate their portfolios, whether it's for Steve's example or whether it's for other examples. I mean, to be fair, I continue to be, a huge believer in the secondary market, and all I think is that what this is providing is an opportunity for even more innovation within this market, which will only set up this market for a bigger boom after we come out of this crisis. So in 2009, for a while, we saw a little dip in volume because there was a pricing mismatch. You were pricing off of peak valuations, the optical discount was too big, nobody was transacting, and actually 2009 volumes dropped by 50%. But then there was a decade-long boom in the secondary market on the back of that. And we're setting ourselves up for the exact same thing here. There might be lower volumes this year as people try and figure out kind of how you go about doing it, but there's no doubt that, what is this crisis doing? I mean, to Chris's point before, it's going to extend duration. When you extend duration, you got to think about other liquidity options. What is there for GPs in the secondary market? There's GP solutions, whether it's continuation funds, whether it's single assets, whether it's preferred to accelerate liquidity. All of those things are going to start really getting. And so what you have is an acceleration of education of the GP market with regards to different tools that they can use to actively managing a portfolio, which is more than just buy a company, add operating value and then sell it. There's a lot of things that you can do in between that enables you to be able to kind of add alpha to your portfolio. And this is accelerating the education curve for the GP. And meanwhile, by the way, there is $7 trillion of private equity or private markets assets out there. I mean, there is no doubt that the secondary market is still very small, even in the traditional space relative to where it can go in the future. So the boom will continue in the secondary market. I think this is actually creating a bit of a pause for a future growth opportunity through innovation.
Yeah, and I think the drivers of new deal activity will be different for each of our segments of the market. Remember, one of the features of the secondaries market now is its real segmentation and specialization because of the innovation that's been occurring over the last few years. In our market, in the GP-led market, I really believe it's still such a simple narrative for the deals that make sense. It's more time and more capital for the underlying portfolio companies to maximize value. And so, in the same way that the great financial crisis from 2009 created the market as hold periods were pushed out, this again for us, this is a nirvana for deals where the GPs need longer hold periods, a longer investment horizon, and potentially capital, whether defensive or offensive, to manage their underlying portfolio companies. And it's again another example of these 10-year closed-end private equity funds do not always correspond perfectly with the business cycle of the underlying companies. And so I think in a suboptimal exit environment and in a challenging market, if it may be for a whole nother year, it's a great time for GPs to innovate. And so single asset deals and continuation vehicles with single companies, where instead of needing to liquidate a company just because you're getting to the end of a fund life, the idea of being able to put that into a new 5-year vehicle and not have to sell it to someone else, I think will be a tremendous driver of volume.
And do you think those single asset continuation vehicles are now a permanent fixture in the secondaries world?
I absolutely do. I think they're going to be a big driver going forward, and it's a lot harder to determine an addressable market universe in that part of the market. It's a lot easier to say how many older funds are coming to expiration, but the single asset tool is something that funds can use throughout their really earlier in their life cycle. And I think sponsors were just starting to figure out this market in 2019, where there were market rumors of multiple billion-dollar plus single asset deals coming to market when COVID hit, and I think it was just hitting its stride, and now this should only reinforce that trend.
I think that's right. I mean, maybe to add on to that, I think what Christophe just said, the number one on the GP side, the number one issue kind of constricting volume right now is just GP education. Because if you speak to a GP and you create an opportunity to hold a winning asset longer, potentially raise additional capital, crystallize the return and then hold the asset for longer, particularly if the exit is private equity, any GP, that's nirvana for most GPs. So on the GP side, the constraint on the, I think on the buy side is just, it is an undercapitalized market at present. So if the volume of deals came that could come, and I think it's absolutely conceivable within a short period of time that single asset deals could be 50% of the GP market will be 50% or more in the secondary market. It will just be that there won't be enough capital, and it will take a little bit of time to build up that capital. But there's almost in terms of a market volume, and one leading secondary investor told me the other day that he thinks the volume will be 500 million in 5 years' time, which I think all of us on this webinar certainly hope it will be. You know, a significant portion of that will be driven by GP, not LPs.
Nigel, who's more bullish than me? 500 billion? That's awesome.
Yeah, it would be amazing. I want to get back
Just a matter of when.
talking about the GP perspective, but you know, Nigel, you mentioned earlier there's a record dry powder in the secondaries market. At the same time, Yann, you mentioned that we're just scratching the surface of what this market opportunity could be, and as a, you know, relative to the overall private equity world, it's still relatively small. Obviously, when you talk about innovation private equity, secondaries has been a big part of that conversation. So as it gets more specialized, secondaries has gone from just a tool for LPs to actually an asset in which they allocate. Right? How do you, you know, in your conversations with that side, as not as a tool, but as a, you know, GP yourself, how do they think about allocation to preferreds versus GP-led restructuring versus plain vanilla, right? And how do you differentiate yourself in a competitive market?
I actually think, so I think what's really interesting is for LPs, they have to start really kind of understanding the various strategies within secondary. So it used to all be bucketed together, and you know, if you look at 2001 and 2004 vintages, they were all doing the same thing. So you know, they're all within a range of returns, and when you look at it, maybe some performed a little bit better than others, but they're all kind of doing the same thing at the end of the day. What you have now is a market that has innovated so much. It's like saying, you know, buyout, one category. Well, within buyout, there is, you know, mega, there's large, there's mid-market, there's growth, there's all that sort of stuff. And eventually what's going to happen is within the secondary market, you're going to have those subcategories around that. We're not there just yet today, but, you know, increasingly as these, you know, sub kind of strategies start kind of coming out, there's going to be people that kind of lean into their part of the market. And then there's going to be generalists that do all of that. And so LPs will have to understand the risk return that they're you're really kind of leaning into, because what's going to happen over time, and I think in this crisis it'll kind of accelerate the understanding of this, is that not all secondary strategies are created equal. They're just different risk returns. You know, it's not that some are better or worse, they're just different risk returns. And so as an LP, you're looking at your portfolio and you're saying, okay, what kind of risk return do I want to put into the portfolio? What is it that I'm looking for? What are the objectives of my portfolio as I'm making this commitment? And understand that, as an example, single asset strategy will create more volatility than, you know, a very diversified LP secondary strategy that is unlevered. So it's, again, not better or worse, it's just different, and you need to understand what you're committing to, because the variability of secondaries is going to really kind of widen here over the next over particularly these next vintage years, and it's going to become increasingly obvious over the next 3 to 5 years.
That's exactly what we're seeing. I think what's resonating with LPs is this idea of actually having to engage in portfolio construction within secondaries. And so I think this, for us, I think what we're seeing is that the spectrum is diversification and more passive on one end, and concentration and active management on the other end.
Yeah, I'd contribute that, you know, a couple of years ago, the last fundraising cycle I was involved with to this fundraising cycle, it's been a step change in terms of LP sophistication. But having said that, it's still really bifurcated. Like, probably in my experience, half of my investor conversations are, you know, how are you different than everybody else? And go walk immediately, like the immediate first question, points of differentiation, what's different? And then the other half of the conversations remain like, why secondaries at all? haven't done secondaries before, like thinking about it, like what are the pros and cons of just generically secondaries. And yeah, I agree with Yann that in the next 3 to 4 years, that 50% that's still asking to be educated about why secondaries at all, it's going to be much more sophisticated, and it's become much more sophisticated just in the last couple of years. And that trend will continue.
Yeah, going to your point earlier, Christophe, about GPs understanding secondaries, and how's that kind of evolved, and what should a GP be thinking about going forward out of this to position themselves to facilitate secondary strategies? Obviously, the LP is their client, and if they can facilitate it, it's service to their client. So, what should a GP be thinking about from best practices to have faster execution and more success in affecting the secondary transaction?
Yeah, I think there are 2 things in there just to separate the two. First part of your question, I think, was more around the market becoming more institutionalized and more accepted, and how are GPs thinking about it. And I would just say that there has been a significant evolution in the GP-led market by just the type of GPs that have been willing to engage on these transactions. I mean, and Nigel can speak to it even more broadly, but what we've seen, I mean, if you look at the number of high profile, well-known GPs, almost household names from TPG and Warburg Pincus and names that have tapped into this market. Just 3 years ago, I don't think GPs were as open-minded to be using this market or even evaluating what their options were. So 2 things have happened. So I think on the one hand, it's become an accepted mainstream tool for all GPs now, but part of that is because of the wider spread acceptance from the LP side. And so I think what GPs have figured out is that as long as you are engaging in the real best practices, which, I mean, by definition, you start with the ILPA guidelines, right? The fact that ILPA guidelines have been issued on these type of transactions sort of makes it mainstream. So, but I think LP-friendly win-win-win type of transactions. Yes, that's a Yann term. But I think GPs have figured out that these can be structured as true optionality for LPs and are great solutions for their underlying companies, which is where all the value comes from.
Option, but not the obligation. Right mindset, right structure, right process at the end of the day can lead to a market that opens up and can only be good for LPs at the end of the day, as long as it's done with a way that they really have the option, but not the obligation. And I think that could lead to, really kind of an interesting tool. But it's not just what can GPs do to the underlying funds. The thing that's also opening up is what can GPs do to their own balance sheet. And I think that's, as you start kind of educating GPs around, what they can do for their LPs, you can also spend a bit of time on what can they do for your own balance sheet at the end of the day. And I think that there's another part of the market that's opening up as people, think about, well, wait a second, we've got a real business here. We're not only investing capital, but we've actually created a real business around this. And so how do we kind of maximize the efficiency of, our own balance sheet as part of this process? And that can get them pretty excited about also the different tools in the tool set from that perspective. I'm also going to raise my hand, and I did a rookie mistake, 3 months into the Zoom world, is that my iPad's about to run out of battery, so I'm going to go grab my charger, and I'll be right back.
All right. Maybe we have a lot of GPs in the audience and many who may have never actually participated in a secondaries transaction. It might be helpful for them to understand just the process timeline, right? If you're doing a secondary transaction for the first time, whether it's a plain vanilla secondary or a preferred or a GP-led restructuring, what should they think about from saying hello to effecting the transaction? Steve, you want to take that?
Sure, I can kick off. Obviously for the GPs in the audience, if it's a plain vanilla LP to LP trade, the role there is kind of when the deal is handshake agreement in place, the GP gets to approve the transfer or not. And obviously, I think one of the trends we're seeing in the market is increasingly more general partners trying to be much more thoughtful about to whom they will approve transfers and why. And I think that is an interesting trend that could continue to develop. So that's on the one end of the spectrum. On the other, much more complex, time-consuming end of the spectrum, I'd be curious for the panelists' views, but it's to the point about ILPA, about communicating really well with LPs, like a GP-led solution that takes the form of a tender offer or a continuation fund is a many months process, because I think first the idea has to be socialized with the LPs, make sure with the LPACs, so to speak, make sure the major investors understand why, what's in it for us, what's in it for you, and then almost always a process has to be run. And speaking on behalf of all the investors on the panel, we would love to do deals in the manager-led space, and some have been done without an advisor, but almost always there's going to be Nigel involved in that process, because the GP has to be able to show the LPs, there was transparency, there was a process, there was price discovery. And so soup to nuts, these are often, I would think at a minimum, 4 months, often 6 month type transactions. So maybe let me pause there and see what the rest of the panelists would add on to that.
But this is the thing about the volume in secondaries, right? So there's a lot of discussions happening right now. So you might think that volumes are low, but what we're doing is planting seeds for a boom that's coming. And so, the reality at the end of the day is you start a discussion now, and the deal will close 9 months from now, 12 months from now. So you'll be like 12 months from now, you'll be like, wow, the market really really hit its stride. Well, it's because there's a lot of legwork that's put into it. So particularly in the GP market, there is a lag between when the opportunity can start being discussed and then when it actually closes. And so don't be fooled that while there might be lower amounts of volume in the secondary market, that it's not busy. It's just seeds are being planted.
Yeah, I think that's maybe just kind of guidelines on transactions. A GP restructuring is pretty unusual. Soup to nuts, I think, as Steve was saying, that is going to be less than 6 months. A tender offer is usually 3, because a tender offer is simply a GP organized LP to LP transaction. And typically one of the motivations of the GP there is that to raise capital for their new fund. So that's a process that takes a little bit longer. But I think that to one of Christophe's points earlier, that the key thing is that these are strategic transactions for GPs. And if the rationale makes sense, which maybe 7 or 8 years ago it didn't to a lot of LPs, but now it does. I like the asset. I want to hold it longer. I want to, take some liquidity off the table. I want to give you, as one of my LPs, actually the option to invest with me in this asset for another 5 years per the ILPA rules. So I think if the rationale makes sense, I think the conversations with your own LPs, tend to be more smooth, because these are fundamentally conflict transactions where the GP is both the seller of the asset and the buyer of the asset. And I think from an LP's perspective, and why it takes a little longer, is there's a price discovery, there's a competitive auction process, that will give comfort for those LPs who want to sell, that a price was determined in a robust way. But for those who don't, you get optionality to continue being invested with that asset, with the GPs, according to ILPA, more or less on the same economic terms as you currently enjoy. So, and I think the benefit now is, I think as Christophe was saying, there is a template, and these are almost like regular way transactions. And I think, as I mentioned earlier, particularly if the exit is to other private equity, then GPs are saying these days, well, if it's a good deal for one of my competitors, then why is it not a good deal for me, for my investors? So, and that, I think, is that whole, notion of keeping your winners and running them longer is really getting traction with GPs, and is likely to be one of the key growth areas in this market.
Yeah, and I'll just quickly add that we focus on transactions which typically only have 1 to 5 underlying portfolio companies, let's say, on average, in one of these continuation vehicles. So it's in effect, I think, what the market has learned, and in large part due to the quality of Nigel and his team's advice to the GPs, is preparation is critical. and spending more time up front preparing what is essentially a multiple asset M&A process. When the advisors finally cracked that barrier with the GPs in terms of running the process, it meant a little more time, and to Yann's point, it's a little more of that lag, but it's meant that the information, so GPs have to be prepared to put together full SIM materials on the companies and get into the underlying data of the portfolio companies and arrange calls with management teams. So, but having all of that preparation and the fact that so many of these deals have now been done to create that precedent in the template, it's meant for a much smoother, more consistent, transparent process that benefits all the different participants in the market.
Yeah, I think often when the process isn't smooth, it also at the same time can create an opportunity for someone willing to roll up the sleeves and do the work. And certainly none of these transactions are overnight type of things and take some time, but the ability to be efficient is obviously a competitive advantage. A GP might spend 6 months doing diligence on a single company before they invest, and you're asked to look at an entire portfolio of assets in that same time frame. And to Yann's earlier point, right now with valuation being a tricky thing, what are marks based on? If every GP has their own view about how to approach this, how operationally are you guys addressing that challenge of evaluating underlying assets and portfolio of assets in a timely basis and doing it meaningfully?
I'm not sure if that was a setup, but I would say one of our key distinguishing features and operationally is that we can rely on a very high quality outsourcing platform called TresVista. That helps us get a 24/7 dedicated service to analyzing underlying portfolio companies, crunching models, spreading comps, and for us that's a big differentiator.
You gotta know your assets. Yeah. I think you got to know your assets, right? So it all depends on the diversity of the underlying portfolio. You're talking about concentrated portfolios like what Christopher talked about, diversified LP portfolios. I think most secondary buyers now have proactive pricing, and so they know to a certain extent, how much they're willing to pay for funds that are kind of in flow to a certain extent, and so. It's a big part of just knowing your portfolios, knowing your underlying assets, knowing what sectors, knowing, healthcare IT probably better these days than airlines and cruises. And there's a lot of under the hood work that needs to get done to really understand where you're generating liquidity, how you're generating liquidity, and understanding, carrying multiples, leverage, operating momentum, alignment with GP, all that sort of stuff is really important. That's what we do.
It's what we do, and I think this market is this exact time in the market's an interesting one because there are still some pretty motivated sellers, even if they're not, denominator effect, even liquidity constrained, that they were thinking about tapping the secondary market as a seller to generate early liquidity. Pandemic hit, and so it kind of put that on pause. But I think what that allows a buyer like us and all the panelists to do is if you were in dialogue before. You can continue that dialogue in this environment. And one of the nice things is this is not necessarily an environment where it's like, the book goes out, to 30 buyers and here's the bid date. It's more like we have interest in this particular asset. We're willing to spend the time. If you, the seller, and you, the GP, are willing to spend time with us, like we'll roll up our sleeves and really do the work. And so there's a deal that we've been working on pretty hard. It's a single LP interest, but it's kind of concentrated 5 companies. And I think in this environment, you trade information for price. And I think we've been able to spend a lot more time with the companies, with the GP, than we ever would have been in a more normal time. And that accrues to our benefit. We can get to a price that works for the seller. We still feel really good about it. It happens to be in an industry that is it's kind of an industry focused fund, and one that is everything's affected by COVID to some level, but this is probably an industry that is less affected than most. And so, it's totally possible to get deals done. And in a weird way, it's kind of a great time to be doing it because again, there's not as much maybe competitive pressure. You can pick your spots. You can be a bit more of a stock picker, and that's kind of interesting. So we'll see how long the market remains this way. We began the conversation by saying maybe it's in the third or fourth quarter that we kind of go back to, a little bit more business as usual in terms of, many processes in the market. But for right now, it's sort of an interesting time to pick your spots, go deep, and just feel good about, where you are deploying capital.
To that end, Steve, what's that fund?
What's that?
What's that fund?
I can't can't reveal,
To the point of needing to execute deep dive analysis and diligence at the asset level. When we started this business 7 years ago, completely dedicated to this GP-led segment of the market, and back in 2012, it was Yann in a previous life doing one of his first deals in the market at the same time that we were doing a deal we didn't even know was going to be one of the precursors of that. It was the Willis Stein deal, and I think Yann was doing Berman Capital. But we had one very strict guiding principle in building the business that we've stuck to, and that was, we think the DNA and the skill sets from direct private equity professionals can be used in this sort of secondaries ecosystem, especially in these concentrated GP-led deals. So for us, we're now 18 dedicated investment professionals, and every single one has been a direct private equity professional managing companies at the board level, and doing that sort of 6 month to 9 month deep dive due diligence at a more traditional buyout shop, as you mentioned. So it's worked really well for us, because now the market having moved also to single asset deals, and there was one in the press yesterday of a recent transaction we've been involved in, actually with Nigel, and we think this is one of the most exciting opportunities to see a single asset deal get done in the middle of this crisis. And it was all about, and if you should see the amount of data that, and analytics coming out of at the company level that we had to go through and dig into to as part of the diligence. I think you just need to be set up to it, because it's completely different than buying a portfolio of LP interest where you get the quarterly reports.
Is this the point in the webinar where we're doing advertisements about our firms?
Sorry.
That was the introduction.
That's the whole point of the webinar. Connecting some of the dots here, Christophe talked about the richness of data and data analytics. Steve, you're talking about trading information for price. Yann, you're talking about innovation earlier. So, is there a couple questions here, right? How is data going to evolve this market? How are you going to apply data analytics as a tool in the secondary world? And is there a way that information asymmetry creates competitive advantage? And is there a way that you guys try to create that information asymmetry? I'd like to go first.
Short answer to that question is yes. If we define information asymmetry, like with the caveat being that we're big supporters of the general partners in these GP-led deals, sharing information with all the potential investors equally, so it's an equal playing field, as long as well with the LPs as well, so everyone can make an informed decision. But like if that's like the stipulation, then like beyond that, yeah, like I think the whole part of being an investor is using information that maybe not everyone else has to your advantage. And one of the things that we're most excited about the next step forward in secondaries would probably be more on the traditional multi-fund portfolio, very diversified side, where whether or not you pursue that portfolio and exactly what you pay for it probably has less to do with like the 200th biggest company, what you think EBITDA is going to be in 5 years and what's the exit multiple. There's probably less about that and probably more about, if this portfolio were a portfolio of publicly traded equities instead of private, could you factor score it, growth, momentum, deep value, like how would you think about that portfolio? Because at the end of the day, that's what it is. It's a portfolio of equities. They're just not publicly traded. So point one is, can you get additional information on the private companies? Yes, maybe depending on your platform, if you have access to a differentiated level of information. And then two, how can you use it to make more informed decisions? So like personally, I'm super excited about data and analytics being better used for diversified portfolios. I'm a little skeptical that it will ever be as powerful on the more concentrated side. I think on the more concentrated side, and I could be proven wrong, right? Totally admit it, because all the big GPs, that have big direct general partners that have big budgets are also investing in data science and analytics, and they're direct, single asset at a time investors. So they seem to think there's application there. But I think when you're doing the 2 to 5 company portfolios, it's more about just fundamental judgment, underwriting, rolling up your sleeves, doing the work. But on the multi-fund side, I think we haven't even begun to scratch the surface of what could be done with data and analytics to make better investment decisions.
Yeah, I think the biggest single opportunity for the use of data analytics and AI is, I think, as Steve said, highly diversified portfolios of LP interest. And I think what you're likely to see over time is just a greater use of that, and almost more certainly more use of machine learning and these sorts of strategies and techniques and technologies. As you have portfolios of 25 to 100 funds with 10 underlying portfolio companies with the data to understand how those sectors, how those industries, how those countries performed over time, that really is not available right now. And I think when that sort of data becomes available and the LP business becomes more tradable, in a sense that that there is a platform that an LP could use to actually disintermediate some of the advisors, frankly, is that the volumes on the LP side are likely to accelerate materially. But I think that almost like the opaqueness still of information is one of the constraints on the market. And I think if you look back at the US, the government bond business, the corporate bond business, those businesses where the banks came together and created shared platforms, it actually created more volume over a period of time as it became more transparent, and more standard in terms of operations, and standard around purchase and sale agreements, transfer agreements, and the like. So standardization of documentation plus a way to transact electronically, which will come in over time, which will accelerate the growth, particularly the LP market. I think Steve's right. Concentrated portfolios, when you're actually partnering with a GP and looking to get alignment with GP, I think there's more limited use there, but clearly there are opportunities to use.
Yeah, we have a data intelligence group, and we spend a lot of time still educating a lot of the middle market GPs on how to use data. Right, it's still fairly new. I think a lot of the larger LPs are quite sophisticated and have been employing data scientists and the data analytic tools for a while, but certainly the market's catching up. Sorry, Christophe, you were wanting to say something.
I'm just going to say something similar, which is we're more focused on how the underlying companies and management teams and the GPs are using the data analytics, because I think it's not just about in the technology industry that gets used. I think seeing how the data analytics applications are used in all sorts of industrial and services businesses is what we're focused on. We're excited about.
Yeah, data's power. We're spending an incredible amount of time, trying to figure out, there's all this data. How do we put it into one single source of truth, the database, and then how do we extract it? And to all the points that Steve made around an analysis of your portfolio where you got information and almost have a dashboard of this fund is a green fund because valuations are flat but EBITDA is going up relative to this you should look into this fund because valuations are going up and EBITDA is flatter down. Then you can start really looking at your portfolios and identifying proactively which ones you feel like you can have a different view than the market with regards to buying and selling over time and all that sort of stuff. So I think that we're in the first stages of this. I think everybody's trying to figure it out. We're certainly putting a lot of effort into trying to build a technology platform that will allow us to stay ahead of the curve with regards to the market.
Yeah, you talk about the first stage of data, kind of the way we view it is you have descriptive, predictive, and prescriptive. And a lot of the data historically that's being used has been descriptive, and the predictions and the prescriptive part is kind of implicit to the investor expertise. But as you're trying to, make that funnel more efficient, the data can actually drive the prediction. This data is descriptive, but then that's going to predict this outcome. And right now, people are still saying, well, then I implicitly know what the prescription should be. But at some point, even the data can say, well, this is the action that should take if this is the data.
But you still need, I still think you'll need the human touch. Like they can give you guidelines around, like, you know, generally speaking, but I don't know that we're getting to a point where we're going to press a button and it's just going to spit out and say.
No,
so there's a human element to all of this. I think that the data can help your analysis. I think if we're talking about press a button, we're still many, many years away from press a button.
It's about creating efficiency for that expert to be able to make that investment decision, yay or nay.
We call it creating mind share.
Does is ultimately say yay or nay.
Yeah, creating mind share. So people are focused on, you know, the deeper level analysis rather than data entry.
Exactly. Machine learning, you can get 85% of the way there fairly quickly with the coding, but that last 15%, you know, it takes thousands of hours of coding to get each incremental percent, and unless you get it 100% there, it has no point, right? So combining the two is always going to be necessary, is my view.
Yeah, I was going to say that the specific use case that gets me most excited is actually top of the funnel triage, because I think we all conform our macro views of, like, I'd rather be investing in certain regions or geographies. One of the challenges of secondaries is the portfolios come across our desk, and even if we have off-the-shelf pricing for a bunch of the funds, sometimes you don't have it on all of them, and you do some work and you add it all up and you're sort of surprised, oh, this portfolio looks a little different than I thought in terms of industry, geography. If you can make better informed decisions top of the funnel on, like, how the team should spend its time and which deals to prioritize, like that, even in and of itself would be a big step forward, I think, in the world of secondaries.
Sure. Yeah. Nigel was talking about efficiency in the market and more transparency. You know, nobody has a crystal ball, but if I were to ask you, do you think, as this market gets more efficient, do you think the 10-year vehicle will become an obsolete vehicle at some point?
Look, I think that the interesting thing is, like 2001, when I started in private equity, we were talking about the fact that 10-year partnerships were unnatural, and that, you know, we should change the 10-year partnership because it makes no sense. We're in 2020, we're still talking about it. And so there's an element of the system doesn't really want to change. And so what you're seeing is that the secondary market has come in and said, look, if the system's not going to change, let us help you. And essentially the secondary market is saying, like, you know, we'll be the liquidity provider, and we'll create innovation around a market that just fundamentally hasn't been able to shift from a 10-year partnership. And so if the system's not going to change, then we'll help you create liquidity within the system that seems to be and does not want to change.
Yeah, and no one's incentivized to change it. In fact, the incentives are the opposite, right? More velocity, more IRR focus, and, you know, there's always a lot of talk about permanent capital vehicles, and a lot of sophisticated institutions have gone and raised long-dated funds and permanent capital vehicles. But I think for the market that we're in, the reason that I think our different solutions and products and the innovation around them has been so successful is because of this constraint of the 10-year vehicle, and how that doesn't always, you know, fit with the asset.
So maybe now I can go to some questions from the audience, and please, if you have any questions, feel free to submit them. I mean, the first question, Christophe, Nigel, what benefit will the LPs get by single asset deals? It seems that they've paid in for the firm to do what they are supposed to do and now need an extension. Will there be concessions?
Well, I think the key, I think there's a couple of things from an LP's perspective, is that if the GP has a great company that they would like to continue owning, the LP gets a liquidity option, but not an obligation. Whereas if the GP, for example, owned an asset for 3 years, done a 2 to 3x on it, ordinarily for prudent fund management reasons, they would want to sell it. But if it's a great asset, particularly if it's a buy and build type of asset that needs more capital to grow, they create an opportunity for the LP to either to cash out or to continue the journey, versus going through a very disruptive process for the company.
Nigel, I think we lost your audio for a second.
I can read lips if you want me to translate.
Sorry, Nigel, I think we've lost you. Maybe Christophe, you want to pick up where Nigel?
No, Nigel was exactly right. it's about the optionality and the way the deal is presented. It is absolutely doing the right thing by LPs, because you're effectively saying those in the LP base that prefer DPI and cashing out at this phase of that business growth can cash out, and those that want to stay in for another 4 or 5 years can do so as well. And so it's actually about that the story at the underlying business. So what if that business had an acquisition opportunity that was transformative for that business, but it had done really well over the 3 or 4 year ownership period, and maybe with the integration of that acquisition or merger, that was the right thing to do in terms of industrial rationale. BP did not go ahead with that deal because they felt their LPs just wanted to cash out. It allows that optionality. Same thing for a changing of a management team, or something went wrong, or there's a big CapEx project that took longer. Anything that just means that the GP believes this is not the right time to sell the company to another sponsor. Remember, we're talking about really we're talking about that market where you just go and auction off another company, and imagine the scenario where 3 or 4 of the buyers in that auction process, the LP is also an investor in those funds, and so you just want that LP is just getting ownership of the same asset across different sponsors, and instead you're getting a cash out option, or you're getting more optionality for the LPs.
It's the so I'm probably talking to myself earlier, but
we got you.
It's the answer to the secondary buyout. Instead of pass the parcel between GPs on assets, that a GP who knows a company better than any other GP because they've been invested in it for several years and doesn't go through a difficult process and disrupts the management, can actually create the optionality Christophe mentioned, without all the downsides. So it's quite unusual that an LP would get the option for liquidity or not, or to continue investing, which is important, I think, because all LPs are not created the same. Some have very different liquidity needs and have very different timelines in terms of when they need to receive cash. So it does create optionality and sort of levels a playing field in terms of LP requirements by giving you liquidity if you want it. If you don't, you can roll over, or you can take partial liquidity. So in a way, it's really giving power back to the LPs, in terms of liquidity, where it used to solely rest in the hands of the GP.
Well said.
Maybe this question is more for Yann. How does an LP distinguish between doing a straight secondary stake sale versus doing a preferred structure?
Yeah, I mean, I think, look, at the end of the day, preferred isn't here to replace. It's supposed to be here to be additive to the secondary market, right? So at the end of the day, there's debt, there's equity, and in between there's preferred equity, structured liquidity solution. And all we've really done is provided folks with a new tool and a tool set. Preferred equity existed in other parts of the market, and it exists very well with both debt and equity in there. And we're just kind of bringing that into the secondary market. So at the end of the day, it depends really what your objectives are. If at the end of the day, like in a market like this, where preferred seem to be, or structured solutions seem to be interesting, was a situation where, look, particularly in March and April, where the denominator effect looked like it was going to be a big issue. You had a situation where the investor might have been over allocated temporarily because private equity was still being priced off as highs of Q4. Public markets was doing its thing. And essentially, you had over allocation to private equity, which would have rectified itself naturally over one quarter as the valuation lag caught up. But the reality is that they were over target for a while, and some institutions have rigid kind of allocation targets. And so you can either go and sell, but at that point in time you would sell at an optically big discount because you're pricing off of Q4. That would have been difficult to bring it to your committee. And some people just didn't want to actually lose the upside of the recovery. And so the offset of these structured solution is an ability to generate and accelerate liquidity to reallocate that allows you to participate in the upside when the recovery comes. So it's enabling tactical reallocation of portfolios during market volatility, and it's just another tool in the tool set with regards to how you could go about doing it. Now, every market cycle is going to have different dynamics and different nuances to why you would potentially want to use the different tools, and the structured solutions at the end of the day will play a different role in different parts of the market and different parts of the cycle. And innovation will continue to enable people to think about their portfolio in a different way, right? And maybe to a certain extent, one of the conversations we were having, and ultimately didn't happen because the market rebounded, but some people were saying, hey man, I'd like to actually generate and accelerate liquidity in our portfolio because we think it's going to be a good buying opportunity, and we'd like to accelerate liquidity so we can invest into the market opportunity because we're going to arbitrage cost of capital at the end of the day. Well, when the markets rebounded, those opportunities went away. But should there be another downdraft? And look, I don't think every crisis is created equal, and I think we're at the front end of this crisis, and I think there's going to be a lot more volatility. I think there's going to be a bunch of W's, but you got to be able to be ready to transact in these different market cycles, and people will do it for different reasons. And then it's just adjusting your product to their objectives, the market environment, the reality, and providing tools. And there's a lot of flexibility that can provide. So as I look at what structured equity can do to the secondary market, it's not here to take away. It's here to add. It's here to do things that other people would have not otherwise done.
Hey, now, another question. Speaking of increasing sophistication in the secondaries market, is there an opportunity for securitization in this market? How and when will that happen? And I know there have been a few instances of securitizations where rating agencies come and rate in tranches, but it's been limited. What's the panel's view on this in the future? Steve, you want to go ahead?
I think that there will be more of it. You're right, Abi. There have been a handful of deals done. I think it takes a certain type of very sophisticated owner of the assets to be sort of willing to undergo like the CFO, collateralized fund obligation process, right? It's like, what are you trying to achieve? If you just want liquidity, a straight sale is probably a little bit easier, more efficient. Maybe a structured solution from the white horses of the world. So like, I think it's a kind of a narrow universe of groups that would ever do it. So I don't see it becoming a huge part of the market, but certainly it'll grow over time, just because it is another tool in an LP's toolkit that's pretty interesting, and if done correctly is probably pretty interesting value maximization from that asset owner who is structuring the CFO.
Yeah, I think I think the first securitization was in the early 2000s, 2001, 2002. There's been relatively a few of them. And a lot of them that have been done, or the ones that have been done, it's been a capital arbitrage. So in other words, that if you create a securitization, you keep the equity, there's a lower charge generally for that capital for certain institutions who've been the key issuers of securitization. So they take a long time. They're expensive, and up to now, you've really been able to achieve similar objectives from just a straight sale in a much shorter period of time and at a much lower cost. And I think as a result of the relatively few securitizations, the buy side really isn't there, and the sophistication of the buy side to understand the collateral. So I think it will increase over time. It generally makes more sense when in a down market, when you're likely to sell a portfolio at a significant discount, because usually then you can take equity accounting. So you could sell the senior tranches, but leave the equity on your balance sheet at NAV till there's proof there isn't a private equity return. So sometimes it's been used to achieve liquidity objectives without necessarily having to take a loss.
And I think the structures will get tested through the cycle, right? And I think maybe when you need it the most, it's not there because the buyers at the end of the day just don't have the capacity or the risk appetite to lean in during a period of time like this. So the windows open and close. It's less predictable than other parts of the market. It takes a long time. It's costly. So it'll happen. It'll continue to happen. But it's going to be another tool in the tool set, and they need to be very large to make it worthwhile. They need to be high quality for people to understand, the underlying assets. So there is a place for them, but it's not like they're going to replace the secondary market. They'll add to it.
Yeah, I was saying there was conferences on PE securitization in 2001, and that's all you need to know.
Another question: when an LP interest is sold, what is a common discount or range of discounts for the price compared to the interest value on the most recent quarterly statement, or is there a discount?
Well, I think it depends on the asset.
Nigel, I think we've lost you again. I don't think we can hear you, Nigel. Someone want to step in?
Yeah, I can step in. I think that what Nigel probably was going to say is the range of discounts just varies widely. There are such a diverse type of underlying assets. Energy funds are trading at massive discounts right now if they're trading at all. And then very high quality growth equity, technology-oriented funds are probably trading at, even in this environment, probably minimal discounts. With the overall caveat that the market is slow, it's slower than it has been, but it's so hard to articulate what is the average discount, because the range is so broad, and it depends a lot on how motivated the seller is. It depends a lot on what are the underlying assets. So I think we've all seen industry data that suggests over the last couple of years, we were kind of operating in kind of a single-digit discount market in general. I think that's definitely changed in this environment. Discounts have widened materially for what is getting done right now. But it's just not to avoid the question. It's just a really, really difficult question to really answer.
Sorry, Nigel, are you back? There we are. Yes.
I would say that is the classic secondary conference question that we've heard for that, and it's a good one, but we've heard it for 15 years, and it's usually the first question. But yeah, I mean, I think that here the reality is that there's a huge amount of capital being raised to invest in this asset class. The actual growth of LP secondaries is actually being lower than GP secondaries, and I think supply and demand just means that prices are going to be higher than they ordinarily would be. And I think that in the market we are in, I think prices remain very strong. I mean, that's my for quality GPs with quality assets, and I think what happens is sort of the last time is that all the capital gravitates to the best GPs with the best assets, and the investors who invested in those sorts of situations did very well. Paying big discounts for mediocre assets and mediocre GPs has always been a losing strategy. So, what we see is this market coming back later this year, but really focused on on the better assets where sellers can get prices that make sense.
Great. Next question: what impact have the buyers seen, if any, from additional competition from non-traditional secondary buyers in the preferred deals, like banks, insurance companies, and credit investors?
Who's going to answer that one?
Well, it's on preferred deals, Yann, so I think maybe
It's a set.
Has there been any competition? Not
So
really.
I mean, I got to tell you, I think I started this by saying I've never seen a market that's so fluid, and every week it changes. I think that 3 to 4 weeks ago, lenders were certainly pretty shy. I think they have resurfaced. I think it depends on which week you're talking about to a certain extent. There's been a shift from should we use preferred equity or NAV-based lending on fund below the fund, and so it depends on the risk appetites of credits and And at the end of the day, with the markets that have recovered, the risk has kind of reopened. That's fine. At the end of the day, as I said, like the whole concept here is like structured equities between the debt and the equity. There's a place for debt. There's a place for structured equity. There's a place for equity. At the end of the day, it's just that they're just different tools that can be utilized in different ways depending on what the situation is and the objectives of the at the end of the day. So. If you would have asked me this 3 or 4 weeks ago, we would have said no competition. If you asked me that today, I would say they're back, and that's fine, and that's great. And I think the market opening up allows people to do different things and gives people options.
I guess related to that question, the next question is talking about folks getting into this market that maybe don't have the history that you guys have. Is there a risk that some of these folks are going to not have innovation, but just have riskier strategies, right? And muck up the market a little bit in the near term.
I wouldn't call it like mucking up the market. I would call it, continued innovation, continued bifurcation, and different groups targeting different segments of the market, different risk rewards, different tools, as everyone on the panel has mentioned several times. I do think it's interesting that, for the most part, if you go back 15 years ago, 10 years ago, the largest secondary funds kind of tend to remain the largest secondary funds, but there have been new entrants, and this panel represents that, and new entrants that have achieved significant success. So I think the market's big enough to accommodate new entrants. I personally think that, if your strategy is undifferentiated or your platform is undifferentiated, it's going to be challenging to raise money to be successful. But I don't worry personally about a flood of new entrants in the secondaries. There really are some significant barriers to entry, and I think the market has shown that by there's not there have been a handful of new entrants that have done it successfully, but not a significant number.
The issue in this market is resource. This market doesn't have enough people in it with experience, and so actually that's the limiting factor of this industry right now. Is you don't just wake up and say, hey, I want to do secondaries, hey, I want to do pref. You have to have built credibility, a reputation in the market, experience, to be able to raise capital, to be able to deploy the capital, to have the relationships in the market. So because the market was pretty niche and pretty cottagey for a while, when you kind of look at how many people have got significant experience that enables that, that's the limiting factor in this industry. And it's not to say that people won't kind of look to come into this market, but it takes a bit of time between the time you decide you come into the market to build out the experience to be able to navigate this very complex world. It is the nuances of this industry is significant. You really have to understand the underlying ingredients, and we're living and breathing it. Each day. We've been doing it for 15 to 20 years, so it's like second nature. But somebody coming in cold on this and trying to understand all the dynamics around this, it's not easy.
Well, and not only that, but it's capital formation. So it's the experience and the lack of resources and people with experience, but the funds have to be of a certain size to be able to underwrite and to actually execute these deals, right? So, I mean, I don't know many people who can just go raise multi-billion-dollar funds as a first fund. So what you see is new entrants focusing on the lower end of the market. I think there are a lot of underserved areas of the market where people need to pick their spots, and fund restructurings below 100 million is still, I think, a very compelling space that people are exploring. But I don't know any GP in the GP-led arena that really wants to be the first one to experiment on $1 billion deal with someone who's never done a deal before.
I think to the point that if you look at the top 10 secondary funds in 2004 and 2018 by size, nine of the 10 were the same.
Yeah.
So I think to the points just being made by the panelists, I mean, I think secondary industry is no different. The big get bigger, the small get specialized, and the ones in the middle need to figure out what to do. And over time, they either need to specialize or they go away. That's just how industry development works. So I think what you're finding here, and in some ways, the size of the current largest secondary funds, you know, are not necessarily sized for the opportunity. Because, you know, when you think about a secondary fund that can do any geography, any strategy, compared with the largest buyout fund, which maybe does buyouts in Europe or buyouts in the US, they're actually in some way undersized for the opportunity.
Wonderful. Well, we have a lot more questions, but unfortunately we're out of time. I want to thank you all for the time today. It's been a riveting conversation, and thank the audience for joining us as well.
Thank you.
Thank you, everyone.
Thank you, everyone.